Hey guys, it's Jenny Silver, and today I want to talk to you gig workers, Uber drivers, Lyft drivers, etc. You guys, if you classify yourself as a gig worker, this video is for you. Now you guys, there's a lot of content out there for gig workers and independent contractors on how to write off all of your expenses, on how to get the most expenses deducted. But there's not a lot of additional content informing you guys of things that you need to know if you are self-employed. Well, as a gig worker, you're self-employed and you're receiving income, then you are self-employed and you are a sole proprietor. Well, you guys, there's some information that you should know, and there's some information that I wish I would have known when I first started out as self-employed 10 years ago. I want to make sure you guys understand these things so that you know how to set yourself up for success from the start. And I also want to make sure that you understand that I'm not a CPA, I'm not an attorney, and I'm not your personal hired coach. So make sure that you are checking in with your own professionals if you have questions specific to your own situation. Number one, you guys, I want to make sure that you understand that you are required to file income taxes if you have self-employment income in the amount of $400 or more in the year. No, you cannot qualify to not file income taxes because you are a low income earner. That applies to W-2 earners. You can see the IRS publication on this that states that if you are self-employed, you are required to file income taxes for $400 of income and above. Now, if you're less than $400, it qualifies as a hobby, but $400 and above of self-employment income, you must file a tax return. Next, it's important to understand that as someone who's self-employed, it's important to be able to track your income and your expenses really easily. It's also important to ensure that you have money set aside in a separate savings account for tax time. So, that being said, I want to make sure that you guys understand to set up two separate accounts that are completely separate from your personal bank accounts. So don't ever have any business expenses come out of your personal accounts. It makes things really messy and really hard to track and prove to the IRS. So what you should do instead is you should set up a separate checking account and a separate savings account. Do they have to be business accounts? No, unless you have a business and you have a DBA and you are operating under that. But as a sole proprietor, just set up a separate checking account and a separate savings account. Why? Well, because when you receive income and you receive payments from either whatever third-party site or app you are working for, or from clients and customers, you want that income to go directly into that additional checking account. You don't want it mixed with your personal expenses. Once it goes into that personal account, you'll be able to have a clear paper trail on the income that you received from that job. And then the next thing that you need to do is 30% of that income that comes into your personal account should be set aside into a separate savings account. Why? For income taxes. Now, your specific amount that you will want to plan to set aside for taxes is obviously going to be a little bit different for everyone. Some people will be taxed in a higher tax bracket and some people will be taxed lower, but in general, a rough estimate that is a good rule of thumb for self-employed individuals is 30%. Why? Because you have three different forms of income taxes that you are paying. Number one, you have your state income taxes. Number two is your federal income taxes. And number three is your self-employment income taxes. Self-employment income taxes are 15.3% current. State and federal income tax number, your exact percentage, can be found on your income taxes that you filed last year. And you can look on your income taxes and see exactly what percentage rate you were taxed at. In general, you should plan between 10 and 25%. So if we take that 15.3% from self-employment income taxes and an average 15% from your state and your federal, that will equal 30%. So that's why that's a good estimate of what is safe to set aside for taxes. So as soon as you receive payments, immediately set 30% aside into that separate savings account. Why does it have to be a separate savings account? Because you don't want to touch it. If you mix it in with your other finances, most likely you're going to be either tempted to use it, or you might dip into it every once in a while by accident, or if it's the only card that you find, you might use it. But separate savings account. Hopefully it's earning a little bit of interest and it can sit there untouched until tax time. The next thing I want to make sure that you understand is that at tax time, You will find a lot of content on YouTube and blogs that will tell independent contractors and gig workers to deduct every last possible expense so that your income is next to nothing and you don't have to pay any taxes or next to no taxes. You guys, that's not necessarily always the best plan, and here's why. This is the information that I wish I would have had when I first started out as self-employed 10 years ago. Now, if you need provable income for any reason, if you are applying to rent somewhere, if you're applying for a mortgage, a loan, anything else that requires a proof of income, as self-employed, your self-employment income, most financial institutions require 2 years of average self-employment earnings to qualify that income and to count it. So if you don't have 2 years of an average stable income, it can often impede you in getting a loan, getting approved on applications, etc. So keep in mind what your financial goals are, what sort of assistance you might be applying for, and if you need provable income. If you need provable income, you're going to want to take into consideration how many deductions you do in fact apply on your tax return. Of course, this is something that you should be talking to your CPA, your accountant about at tax time. The next thing that I want to go over is very important and something that newly self-employed people often don't realize. When you pay your income taxes, the first year that you are self-employed, you will pay your income taxes. If you made more than $1,000 in earnings during that period, you will then be required to pay quarterly estimated income taxes for the next year. That means that every 3 months going forward, you're going to have a payment due to the IRS. That is what you owed in taxes, broken down into 4 payments over the next year. So that by the end of the year, the goal is that you would have paid your estimated amount that you would owe in taxes. So you will be required to do this by the IRS if you made $1,000 or more in your last tax return. So for your self-employment income, you need to count on filing your income taxes, paying your tax bill, but then also immediately due at tax time when that is due is going to be your first quarter estimated income taxes. Now, many people don't know to plan for that first quarter estimated payment and they are stuck not knowing what to do or how to scrape the money together. So make sure you know to plan on that if this is your first year at filing income taxes as a newly self-employed person. Okay, you guys, I hope that was helpful. Please click like, subscribe, and leave me a comment down below.